Let me ask you a question most business owners avoid. If you got hit by a bus tomorrow, what would you be leaving your family? Your wife or husband is grieving your death. They're trying to console your children, but yet you have this business over here that needs to be run. Who's going to sell the business? Is it going to continue to operate? What's going to happen to the team members? What about your customers? There's all these unanswered questions because you didn't attend to your affairs before you got hit by a bus. And what about your valuation? You were generating cash flow to fund your lifestyle, whatever that lifestyle was, while you're operating your business. But now your business doesn't have the operator. Were you too involved in the business? Were you driving the valuation of your business? And do you understand what those drivers are of valuation to make the value of the business go higher and make a buyer, whether strategic or private equity, want to acquire your business in the first place? There's a lot of unanswered questions if these affairs aren't in order before you get hit by a bus, before you have a terminal disease, whatever the case may be. I know it's blunt and we don't want to talk about it, but it's something that business owners need to address head on, or they're going to leave their family with a pile of rocks. You need to understand valuation. You need to understand what drives valuation. You need to prepare your business to sell, and you need to have things in place in order to make that happen if you do get hit by a bus. Today, we're going to walk through those factors step by step to understand what drives valuation and how you can increase it by focusing on those factors at a high level. I'm Nick Bartolo, the founder of Essential Partners. After looking at thousands of transactions during my 17 years on Wall Street, our clients have exited over $500 million in business sale transactions over the last 18 months. We work with founders across many industries in the trades: lawn care, pest control, roofing, cleaning, fire safety, et cetera, et cetera. What I want to do is I want to simplify the valuation process to you. Not ivory tower, not academic, but real world, what a capital allocator thinks when they're looking at your business, its valuation, and the drivers of that valuation. That way you're prepared and your family's prepared if you get hit by a bus. Let's dig in to some core concepts as it relates to valuation. Who knows what EBITDA is? I meet business owners across the trades that have 10, 20, $30 million in revenue, and they don't know what EBITDA is. Put simply, and just defining the acronym, EBITDA is earnings before interest, taxes, depreciation, and amortization. So that's essentially the cash flow your business generates before you pay any interest on debt, before you pay the IRS or state tax authorities, and before you depreciate or purchase any equipment to help run that business. However, there are adjustments that can be made to EBITDA in order to derive a valuation by applying a multiple. Some of those adjustments might be the compensation that you're paying your family through the business. They strip that out or add it back, which increases your adjusted EBITDA. There may be some personal vehicles that you run through the business, and I'm not here to dissuade you to not do that, but those also get added back, which boosts your overall EBITDA. So after a number of adjustments or add backs, you get an adjusted EBITDA number. And then here comes the fun part. The adjusted EBITDA number, that's kind of the science. Like, you can go through that and it's a rote calculation once you know what to add back. But then the multiple that's applied to that EBITDA, or the multiple that you times that EBITDA by, results in the valuation or the enterprise value of the company. The multiple is more art than science. Sure, there's lots of transactions in an industry, and that multiple will be compared to all of those transactions, but there's a number of factors that can influence what that multiple is that a buyer is willing to pay for your business. And then ultimately, and we'll talk about those factors later, ultimately, that's going to result in an enterprise value for the entire business. Once you multiply adjusted EBITDA times the multiple and get the enterprise value, now you have to reduce all of the net debt within the business, and that's what you actually receive as the owner of the business. So by net debt, I mean all of the debt associated with the business, any debt that's related to the trucks, the equipment, etc. That all needs to be paid back, and then you're left with the proceeds that are left over. When I think about valuation, I think most of the small business decisions can be filtered through three factors in order to drive a higher valuation. Growth. So how is the business growing on a top line and an EBITDA basis, so revenue and EBITDA into the future? What's the historical growth rate and what's the expected growth rate? The second factor is durability. So of that EBITDA, do we think that's likely to continue to persist into the future? So it's not necessarily thinking about just next year's EBITDA and the durability of EBITDA, but thinking it on a long-term basis and how protected that EBITDA is. And the last factor is risk. So are there more short-term risks on the horizon or in any given year that could drive that EBITDA down unexpectedly? This could be a business that's economically sensitive. It could be high customer concentration, et cetera, et cetera. But as you're thinking about your business and wanting to drive the valuation higher, those three filtering mechanisms as business decisions come up day by day can be critically important to driving a higher multiple to apply to your EBITDA to then result in a valuation. Let's dig into these factors a bit more. When buyers look at your growth, they're not just looking at EBITDA growth and they're not just looking at revenue growth. They're looking at the combination of the two and the sustainability. So if a company has drastic EBITDA growth that's purely driven by margin expansion, buyers will question that as more of a one-time item versus revenue growth that's sustainably growing over time. The buyers will want to know where that growth is coming from. Is it coming from simply acquiring new customers through normal organic channels? Is it coming from acquiring new businesses? So maybe there's an add-on acquisition in the company's local market. And lastly, could that growth be coming from pricing? And depending on the situation, depending on the narrative, the buyers will view those growth drivers differently, which could either lead to a higher multiple or a lower multiple. They also want to understand the factors behind that growth. So is it due, let's say in home services, to population growth in a given area? Or is it due to market share growth? Or is it due to expanding to a new area? All of which can impact the multiple. But the real factor with growth is that the higher and more sustainable the growth, the higher the multiple. And that's what buyers are paying for, because ultimately buyers are paying for cash flows or EBITDA. And if that EBITDA is likely to be much higher in the future and durability and risk, which we'll talk about next, are not main concerns, then all else equal, higher growth is surely going to lead to a much higher multiple. Now let's talk about durability, or you could even call it predictability. Recurring revenue is a huge topic across the trades, home services, software, and many other businesses. And the reason recurring revenue is so important is because it creates this predictable stream of revenue, particularly for low priced items in someone's life that just recurs month after month, gets billed to the credit card, gets billed to the corporate card if it's a business service. And that recurring revenue becomes very predictable. But there's a nuance to recurring revenue that you all likely know, and that's retention. If you have high recurring revenue percentage as a percentage of your total revenue, but you don't have high retention, meaning you're having to replace customers time and time again because you're continuing to lose customers, that recurring revenue becomes far less valuable. So as much as you can drive up your retention, that way it becomes much more predictable and more durable over time. That's clearly going to increase your multiple. But all else equal, you could have one company with 90% recurring revenue and another with 70% recurring revenue. But if the company with a 90% recurring revenue has far lower retention and issues keeping their customers, that will result in a lower multiple, all else equal. There's a number of factors that could influence the durability or predictability of a given company's EBITDA stream. It could be threat of new entrants coming into your market and trying to take market share. It could be that's not possible because you have such brand power and local presence that allows you to keep that level of EBITDA durable into the future. One of the biggest factors over time that's disrupted business models and made EBITDA less durable is technology changes. So technology is continuously evolving, and obviously businesses that have less of a risk of technology disruption have a more durable EBITDA stream. Switching costs can also have a big impact on durability. So if it's easy for a customer to switch from one service offering to another, that obviously puts durability at risk, which all else equal would make the multiple go down versus another service that has high switching costs. So it makes it harder for the customer to switch service providers. But overall, the level of durability of your business and the cash flow that it produces, if that durability is higher, the multiple a buyer is willing to pay for your business is higher. Now let's talk about risk. I think about risk on many dimensions, but let's think about it on a short-term basis. So what is the risk that your level of EBITDA or sales is likely to grow and be the same in the next year? Do you have high customer concentration to where if a customer were to cancel, that EBITDA level is now at risk? Is there something about your balance sheet? Do you have too much debt? And so if there was a business disruption, you can't make your interest payments, now your entire business is at risk. Another measurement of risk would be margin volatility. So is your margin going like this up and down every year? Because a buyer is going to look at that and think that that business must be risky because they can't generate smooth, consistent margins. Maybe it's a cyclical business. I know we haven't had an economic cycle in North America in 15 plus years as the economy has continued to chug along, but there's a number of businesses in the trades that are sensitive to economic cycles. So if there were a downturn, if there were a recession, what is the likely result to your business? Are you likely to see projects canceled, revenue go down, margins go down further? Because that clearly is a risk in those types of business. And if that risk is higher, the multiple is going to be lower. Another risk is you, management, and management's decisions. So are you pursuing high return projects that drive sales, EBITDA, and margins and predictability? Or are you pursuing the projects with an uncertain outcome that could result in losses? It's a big project. The revenue looks sexy, but your team does not execute. Next thing you know, that project isn't profitable and you're left with a negative EBITDA. Just remember, buyers are not necessarily paying for what's working today. They're thinking about the business and projecting it into the future. Ultimately, the true value of a business is the current value of all future cash flows. So they want to think about growth and what that EBITDA is likely to be into the future. They want to think about durability and whether or not that level of cash flows is likely to persist into the future and for how long. And lastly, they want to apply risk to that business. So is there a risk that these cash flows could go away due to some key factors? Now let's go one layer deeper, because this is where most founders lose the plot. When a buyer looks at your business, they're not just looking at EBITDA, they're looking at how the EBITDA is produced. Metrics like recurring revenue percentage, labor efficiency, backlog duration, working capital intensity, overall capital intensity, return on capital in the overall business and balance sheet. I mean, two businesses can both generate $2 million of EBITDA, but how they do it and what it requires can be very different. Take business A that requires no reinvestment into the business. You've made the investments up front. You have the team in place and you're able to grow that EBITDA without further investment from the owner's pocket. And then take business 2, where you do have that same level of $2 million in EBITDA, but it requires constant reinvestment, buying new equipment, replacing the trucks, rehabbing the facility. That business is far less valuable than the one that doesn't require that capital investment. So if you're thinking of your business and you want to drive a premium valuation, the first thing you have to have is clean financials. And then from there, once you have the financials, that can give you a window into actually making better decisions within the business. Another factor, and I'm just going to go through a list here, consistent margins, leadership that doesn't rely on you, systems that scale. That could be people, it could be technology, it could be equipment. Geographic density. Are you all in one area with tight routes that's leading to high profitability? Or are you spread out with a lot of windshield time in home services that's leading to lost revenue and wasted labor? And lastly, do you have a clear competitive advantage? How are you different from your competitors? How do customers see you in terms of brand power and the points of differentiation versus your competition? And this is what private equity and other buyers see immediately when they look at your numbers and they're thinking about that art or what multiple they're going to apply to your adjusted EBITDA. This isn't about working harder. It's about being intentional about building a business that has value without you and in the eyes of a financial buyer who's buying the cash flows or EBITDA. Let me bring this back to where we started, the bus, because this isn't really about selling. It's about being prepared. If you did get hit by that bus, would you have somebody to run the business, or is it all dependent on you? Do you have somebody to sell it? Do you have somebody to mitigate taxes and manage the portfolio after you sell the business? Or in their grief, would your family be guessing? Would they be left with this spaghetti string of operations and no scalability while they're trying to grieve your death? Would they just be guessing and hoping at the worst possible time? You don't have to sell and you don't have to care about valuation, but if you put these pieces in place, you'll actually make more money and build a lower risk, higher growth, and more durable business in the meantime. And at the end of the day, that's what we all want for our families, whether you sell the business or don't. I don't care if you sell your business, but you should run the type of business that can be sold any day you get hit by a bus.